Something just changed in XRP that matters more than it looks. While most attention is focused on price movements, a much bigger shift is happening across global finance, payment systems, digital assets, and monetary infrastructure are being redesigned. In the next few minutes, we'll examine the signals behind the shift, why institutions are studying new financial rails, and where XRP fits into the broader conversation about the future of money. See, the global financial system is entering a period of structural change. For more than 80 years, one idea has dominated international finance: a single reserve currency, a connected payment network, and a monetary order built around the US dollar. But financial systems do not stay fixed forever. The warning signs usually appear quietly before major transitions happen. A regulation changes, a payment network expands, a central bank tests new technology, an international institution publishes research on digital infrastructure. Individually, these events can seem unrelated. Together, they reveal a larger question: what happens if the next stage of finance becomes more digital, more interconnected, and less dependent on a single system? That is why recent discussions around tokenization, interoperability, and decentralized assets have attracted attention beyond the crypto market. The debate is not simply about XRP or any single cryptocurrency. It's about whether digital assets could become part of the infrastructure connecting tomorrow's financial system. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the market. History offers an important lesson. Financial systems don't collapse overnight. They evolve, they adapt, and eventually they are replaced by something better suited to the world that created them. Consider the collapse of Bretton Woods systems in 1971. For decades, after the Second World War, the global monetary order depended on the United States dollar being convertible into gold. It created stability, encouraged international trade. It rebuilt a devastated global economy. But over time, the economic realities changed. The United States issued more dollars than its gold reserves could comfortably support. Confidence weakened. Eventually, President Richard Nixon suspended gold convertibility. The world entered an entirely new monetary era. The old system didn't fail because it was poorly designed. It failed because the world around it changed faster than the system itself. Today, some economists argue that another transition could be beginning, not necessarily away from the US dollar overnight, but toward a more multipolar financial landscape in which digital infrastructure plays a larger role. There's a lot of academic papers floating around the internet about a lot of possibilities, possibly a Bretton Woods 2.0. But this is a discussion rather than an established outcome. One concept sits at the center of this debate: the Triffin dilemma. It sounds complicated. It really isn't. Imagine one country's currency serving two different purposes. Domestically, it supports that country's own economy. Internationally, it supplies liquidity for global trade. Those two objectives don't always align. What's good for the world isn't always good for the issuing country. And what's good for the issuing country isn't always good for the rest of the world. Write that down. That's massively important, ladies and gentlemen. Again, this tension has existed for decades. Some economists believe growing geopolitical competition, sanctions, and efforts by several countries to diversify aspects of their international financial relationships have renewed interest in alternatives or complementary systems. There's a lot of arguments in this environment about increased demand for political neutrality, settlement mechanisms. This remains an academic thesis rather than a consensus policy direction. But here's where it gets interesting and spicy, ladies and gentlemen. The debate is shifting away from replacing one currency with another. Instead, some researchers are asking whether technology itself could become the bridge, not replacing sovereign currencies, connecting them. See, for decades, international payments have relied on networks built for a very different world. They were designed when transactions moved slower, when financial markets were less interconnected, when digital assets didn't exist. See, today, trillions of dollars move across borders every day. Businesses want faster settlement. It's natural. Banks want lower costs, 100%. Governments want greater transparency. See, central banks are actively researching digital currencies. Commercial banks are exploring tokenized deposits. Financial institutions are experimenting with programmable money. This is why organizations like the Bank for International Settlements have increasingly focused on tokenization, interoperability, and preserving trust in the financial system. While the BIS does not endorse any specific cryptocurrency, in certain materials that's being passed around through discussions, They highlight the challenge of fragmented digital payment ecosystems and the need for more seamless infrastructure. Short-term noise, long-term infrastructure. That's where institutional attention tends to focus. Think about the Silk Road, ladies and gentlemen. Okay. The roads themselves weren't the source of wealth. They simply connected economies. Merchants still traded different goods. Kingdoms still used different currencies. Cultures remained distinct, but efficient connections transformed commerce. Modern payment infrastructure could play a similar role. The real value may not come from replacing every national currency. It could come from making them work together more efficiently. Let that sink in. That's so massive. It really, really is. That's why today's institutional conversation increasingly creates and centers on interoperability rather than uniformity. And that's exactly where the next chapter of this story begins. Because while academics debate the future, central banks, regulators, and financial institutions are already building a piece of tomorrow's financial architecture. If there's one lesson history teaches us about financial innovation, it's this. Markets may move quickly. Institutions do not. Banks don't rebuild global payment system because the technology is exciting. No, they don't. See, governments don't rewrite financial regulations because investors are enthusiastic. They move when the risks become manageable, when the rules become clear, and when the infrastructure proves itself under real-world conditions. That's why one of the most overlooked developments in digital finance today isn't a price chart. It's regulation. Because before institutional capital flows into any new financial infrastructure, it demands one thing, ladies and gentlemen. Let this sink in. Legal certainty. Now, this is what most people miss, because if you don't got legal certainty, you got ungats, you got nothing, you're going nowhere. The biggest obstacle to institutional adoption has never been the technology. It's been regulatory uncertainty. Without clear rules, banks simply cannot allocate meaningful capital, regardless of how promising an innovation appears. That is beginning to change, ladies and gentlemen. See, Europe has quietly positioned itself at the forefront of digital asset regulation. Rather than attempting to prohibit innovation, policymakers have focused on creating a legal framework capable of supporting it. The Markets in Crypto Assets Regulation, better known as MiCA, is widely regarded as one of the world's most comprehensive regulatory frameworks for digital assets. Its objective isn't to promote one company or another cryptocurrency. Its purpose is much broader. Create legal certainty, protect consumers, reduce systematic risk, and provide institutions with a predictable regulatory environment. Against that backdrop, Ripple's reported preliminary regulated approval in Luxembourg represents an important milestone because it can allow compliant digital assets and stablecoin services across much of the European economic area, subject to meeting all the regulatory conditions. The significance lies less in one company and more in the broader trend towards regulated digital asset infrastructure. Price reacts to headlines. Institutions react to legal frameworks. And those are rarely the same thing. See, behind closed doors, the competition isn't really about launching another cryptocurrency. It's about building the next generation of financial infrastructure. Around the world, banks are researching central bank digital currencies. Commercial banks are experimenting with tokenized deposits. Asset managers are exploring tokenized securities. Settlement providers are testing programmable payments. Every institution asking essentially the same question. How can money move faster, cheaper, more securely without sacrificing trust? That question has become even more important as cross-border trade continues expanding while existing settlement systems remain fragmented. This is precisely why interoperability has become one of the most discussed themes with institutional finance. Because digitizing money solves only half the problem. Making different systems communicate with one another solves the other half. See, the Bank for International Settlements has repeatedly emphasized that trust remains the foundation of money. Technology alone cannot replace confidence. Instead, digital infrastructure must preserve it. Recent BIS discussions have also highlighted another challenge: fragmentation. See, today's digital assets ecosystem consists of numerous independent blockchain networks. Each one functions well internally, but communication between them remains inconsistent. The reference material notes that the BIS has discussed fragmentation across blockchain ecosystems and the need for interoperability, while observing that it does not specifically endorse XRP or Ripple's RLUSD stablecoins. Those connections are interpretations made by commentary rather than official BIS positions. That distinction matters Facts matter. Interpretation matters. And understanding the difference is exactly how institutional investors analyze emerging technologies. But here's where the story becomes even more spicy and interesting. If interoperability becomes one of the defining characteristics of future financial infrastructure, then companies already working in that space naturally receive greater attention. Not because success is guaranteed, but because the market is searching for potential solutions. Financial infrastructure, ladies and gentlemen, isn't built overnight. It's like watching paint dry on the wall. Neither is trust. One argument frequently made by XRP supporters is that the past decade has served as an extended period of testing. Technical testing, operational testing, regulatory testing, market testing. There's a lot of years of regulatory scrutiny that's gone on, including the SEC litigation, as the evidence that the ecosystem has been forced to mature under unusual intense examination. So supporters view that period as strengthening its institutional credibility, although opinions differ on how much that experience translates into future adoption. Regardless of where someone stands on XRP denoting one specifically, one broader lesson remains. Institutions generally prefer infrastructure that has been already tested under stress. Banks do not like uncertainty. Payment systems cannot avoid failure. Financial markets reward resilience. The principle applies whether we're talking about traditional payment rails, cloud computing, or blockchain networks, ladies and gentlemen. I love history. It provides us with another useful example. When Swift messaging network emerged in the 1970s, it wasn't immediately viewed as revolutionary. It was quite boring. But in fact, many banks continued relying on older communication methods. Adoption took years. Trust had to be earned. Standards had to be developed. Feelings had to be healed. Participation and participants had to agree on common protocols. Only then did SWIFT become one of the foundations of modern international banking. Financial infrastructure often evolves this way, slowly, methodically, almost invisibly. Till one day, everyone simply assumes it has always existed. That doesn't mean today's blockchain networks will inevitably follow the same path. But it reminds us that the infrastructure transitions are usually measured in decades, not months. See, every market cycle creates distractions. Bull markets celebrate price. Bear markets magnify fear. Social media amplifies whatever captures attention on that day. Meanwhile, institutions continue building. Central banks continue researching. Regulators continue drafting rules. Payment companies continue testing infrastructure. That's why separating short-term market volatility from long-term structural development has become increasingly important. Because the two rarely move together, ladies and gentlemen. You have short-term noise, long-term structure. And this final chapter of this story, we're going to explore how geopolitical reserve currencies, stable coins, and the future of international liquidity could reshape global finance, and why investors are watching developments such as legislative clarity, institutional payment networks, and the broader evolution of digital financial infrastructure for more closely than the daily price movements. For decades, ladies and gentlemen, the global financial system has largely revolved around a single center of gravity, the US dollar. It remains the world's dominant reserve currency. It dominates international trade, it dominates global funding markets, and it continues to underpin much of the world's financial infrastructure. But dominance doesn't mean permanence. History suggests that every monetary system eventually adapts to changing geopolitical and economic realities. Today, those realities are changing faster than they have in decades. Trade is becoming increasingly regional. Strategic competition between major powers has intensified. Countries are looking to diversify parts of their reserve holdings, payment relationships, and supply chains. This doesn't necessarily mean the dollar is about to lose its reserve status. Far from it. Reserve currencies typically evolve over long periods, often spanning decades rather than years. Write that down. What many economists are discussing is not the sudden replacement of the dollar, but the gradual emergence of a more multipolar financial system. One where multiple settlement mechanisms coexist. One where digital infrastructure complements the traditional finance rather than replacing it. And one where interoperability becomes more valuable than exclusivity. This broader macro backdrop is one reason why debates around digital asset and digital settlement have become more prominent, particularly as policymakers and institutions explore new payment technologies alongside existing financial systems. Much of today's conversation revolves around stablecoins, and for good reason. They replace and represent one of the fastest growing segments of digital finance. They provide price stability. They enable faster settlement. They can move value around the clock. but institutional discussions have already moved beyond stablecoins themselves. The bigger question has become, how do different assets communicate with one another? How do tokenized deposits interact with central bank digital currencies? How do regulated stablecoins settle across different jurisdictions? How do multiple blockchain networks operate together without creating new forms of fragmentation? These are so important questions, ladies and gentlemen. You have to understand there's arguments going on that this challenge is becoming increasingly important, and it suggests that Ripple's infrastructure, and RLUSD may be well positioned to participate in solving interoperability problems. That is an interpretation presented by supporters rather than established industry consensus, but it reflects one of the major themes emerging around digital finance. This is where infrastructure begins to matter more than individual assets. Markets often focus on what people can buy. Institutions focus on what entire systems can build. I want you to think about the Roman road network for a second. The roads themselves weren't valuable because they were made of stone. No, they were valuable because they connected an empire. Merchants could move goods. Governments could administer provinces. Information traveled faster. Commerce expanded. The roads created efficiency. Modern financial infrastructure may follow a similar principle. Tomorrow's payment network doesn't necessarily become valuable because one technology replaces everything else. No, it doesn't. They become valuable because they connect everything that already exists. Let that sink in. That's so important. Different currencies, different banks, different jurisdictions, different digital assets. Interoperability could become the digital equivalent of those ancient roads, now replacing economies, connecting them. And that distinction may prove more important than many investors realize. Retail investors often think in weeks, ladies and gentlemen. Traders think in days. Institutions think in decades. I always tell you, we don't really deal with retail clients. We have a totally different conversation with family offices, the families, sovereigns, hedge funds. It's a completely different conversation. When pension funds evaluate infrastructure, they ask whether it can survive 20 years. When central banks design payment systems, they ask whether they will remain secure for an entire generation. When regulators create financial frameworks, they aren't trying to predict tomorrow's price. They're trying to build confidence for the next 20 years. The difference in timing horizon changes everything. It explains why so much work happens quietly, why policy matters, why regulatory approvals matter, why technical standards matter, because financial infrastructure isn't judged by excitement. It's judged by resilience, and resilience takes time. So where does all of this leave us, ladies and gentlemen? What does it leave, right? That's a big question. Perhaps with a more balanced perspective. Write this down. There's genuine evidence that the financial system is modernizing. Central banks are exploring digital money. Governments are creating regulatory frameworks. Institutions are investing heavily in tokenization. Cross-border payments remain an area of active innovation. Those are observable trends. At the same time, many claims about the future role of specific assets, including XRP, the anointed one, becoming a global liquidity anchor or a central component of a future Bretton Woods 2.0 system, remain a hypothesis discussed by academics and market participants rather than established outcomes. You have to realize everything should be understood and taken as speculation rather than certainty. Every conversation, any piece of literature found in the internet, you have to have a contrarian point of view, and you have to understand speculation always. It's not financial advice, no matter what you read, speculation. The distinction is essential to understand speculation from certainty, always, because markets reward disciplined thinking, not certainty. The investors who consistently outperform are rarely those who predict the future perfectly. They're the ones who understand probabilities, who recognize structural trends, and who remain patient while those trends develop, ladies and gentlemen. Prices reacting, systems evolving. Always pay attention to what's quiet. History has shown us that every major monetary transition begins quietly, long before the headlines, long before the markets fully understand what's happening, and long before the average investor pays attention. The Bretton Woods system wasn't built overnight. The global dominance of the US dollar wasn't established in a single year. SWIFT didn't become indispensable the day it launched. Financial infrastructure evolves gradually until one day it simply becomes the new normal. Whether XRP ultimately becomes a meaningful part of that future remains uncertain. What is certain is that the global financial system is entering one of the most significant periods of technology, transformation, in generations. Tokenization is advancing, regulation is becoming clearer, cross-border payment systems are modernizing, and institutions are preparing for a future where digital infrastructure plays a much larger role than it does today. The real opportunity may not lie in chasing every headline. It may lie in understanding the structural forces quietly reshaping global finance beneath the surface. Because while markets often reward momentum in the short term, History has consistently rewarded those who recognize structural change before it became obvious. Short-term noise, long-term structure. That has been the truth throughout financial history. Always been true. And it may prove true once again, ladies and gentlemen. If you've enjoyed this deep dive into the future of the global financial system, make sure to subscribe to the channel, turn on notifications so you never miss the next institutional macro analysis. If you found value in today's discussion, leave a like. It helps more than you think. And let me know in the comments. Do you believe the future of global finance will continue to revolve around today's monetary system, or are we witnessing the early stages of a new financial architecture? As always, thank you for watching, ladies and gentlemen. I'll see you in the next one. Hope everyone's having a blessed day, ladies and gentlemen. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. Ladies and gentlemen, you have to understand something. In this game, you have to be so disciplined, and it pays to be early. It pays to have your own hypothesis, your own recce, your own research. As financial mercenaries, why? So funny. One of the family offices of families have retained us for many years. They actually like watching the YouTube channel very much. I'm amazed by this. I really, really am. They ask me all the time, why financial mercenary? I said, that's why we work for your family and you. We find scenarios that most people are not paying attention to. That's what being a financial mercenary means. You will have to do the same thing over again. You will have to beat the market every day, always, to survive in this industry. This game, it's like surviving combat. It's financial combat. You have to survive. So the trade craft here is to pay attention to reports, abnormalities, disruptions, everything. That's the difference of winning and losing, being first mover. See, the way you get ahead in this game is to understand true economics, supply and consumption. If you understand this, you can see everything. Ladies and gentlemen, if you want to learn how to trade, okay, if you want to learn how to invest, if you want to learn how to take advantage of what's happening in today's world, in equities, futures, crypto, everything, come and join the Crypto Public Desk Monthly, ladies and gentlemen. Join over 600 active traders and investors. Doesn't matter if you're seasoned, doesn't matter if you're just beginning your journey. Learn how to digest the deeper macro research, because there are people taking advantage of the chaos. You read about it every day. I mean, I'm not talking about insider trading, anything like that, but there are people getting extremely, extremely wealthy off of the news. Someone taught them. That's why it pays to be first mover into markets. But today's world is changing. Why I say we're the remora. We feast on the sushi underneath everyone. Okay? Simple game. Simple game. Choke points around the world are more important now. The ones that are being built are even more important right now. Going to be going over this in the Patreon, Crypto Public Desk Monthly, about the next choke points being built, because that's going to control supply and demand and the companies building them, the areas building them, and why. You can discuss and despise different cryptos. I don't like this coin sucks. That's like saying someone on the floor of the New York Mercantile Exchange, I'm not going to go into the RBOB pit because RBOB sucks. I'm going to stay in the heating oil pit. You know what? I don't like RBOB. It's garbage, so out of the way. Who would say such rubbish? But you have to understand something. The BRICS unit, they made a move on the US dollar, the treasury system. I've been going over this in the rants of our video for so long. It's amazing, right? That's why the world is different right now financially. There's a financial war going on right now. Learning to take advantage of this is most important. I don't see the unit being successful. I don't. It's tied to metals. At some point, the dollar will stop rallying and go down. But the way that news is consumed, disseminated, and given to investors and banks has changed. They have to understand that nothing's telegraphed anymore. People actually have to work. That is causing phenomenal opportunities. Phenomenal. It's knowing where to look. It's like we're on the Serengeti right now. It's the dry season. As the pools of water get smaller, fish become carnivorous and have to eat each other. There's not enough oxygen in the water. Whether one cryptocurrency dominates them all, I don't care. I don't. I care about being correct for myself, my constituents, my benefactors. That's all I care about. If it makes sense, it makes dollars. You know how many people getting caught up like sushi right now? Digitization, is happening. Sorry. It's happening only because the world is changing. Look, the drama in the Middle East showed us one thing. HSBC came out and started to talk about tokenized gold. People sold their gold when they couldn't get out of the Middle East during the last conflict. They sold their gold in one place and they repurchased it in another place. They weren't taking all their gold physically with them. That'd be too hard. That's why we saw discounts in the physical markets over there. The banks took notice of this. See, banks aren't going to change until they're pried to change, until they have to change. That's why in this business, nothing gets done until the end. Okay? It doesn't get done until the end. None of this is financial advice, just my own opinion and retention any capacity. So as we're going through this situation, understand this. Nothing will change until it's forced to change, until banks can make money off of this. And that's happening right now. So what we're paying attention to, I went over this. We're paying attention to copper, lovely copper calls. If you want those, come and join the Crypto Public Desk monthly. We're paying attention to commodity structural disruptions. These can be man-made. These can be geologically made. But when they are created, they tell a story. Ladies and gentlemen, have a blessed day. I love you all. I'll see you on the front lines. This information is for educational information purposes only. This is not financial advice. Always do your own research. Consult a licensed financial advisor. Never invest any capital based off of watching a YouTube video. Don't do that. I love you all. I'm going to see you on the front lines. If you made it to this point, this is the Italian ice candy. Look, I talk about history a lot here because an analogy, a comparison, is the best way to convey complex themes. I've been doing this game, because to me it's a game, my entire life since I'm 15 years old. It's the most captivating, rewarding thing. Once you're taught how to trade and invest, both of them, you'll probably never want to do anything else ever again. Because once you can do a skill over and over and over again throughout all asset classes, you begin to say, I love this game. I was born for this. That's why I don't have the patience to watch sports. To me, sports are a waste of time, unless you're like a bookie or something, unless you're gambling on that, unless you're making money from that, but I pay attention to the financial markets. I don't have the time for sports. When I play golf, I'm terrible. People think I just let them win on purpose. Sit me at the lunch table where people are talking about financial ideas, financial innovations. Sit me next to people that are talking about where the world is going. That's the lunch table I belong at. Because to me, the most amazing thing about the internet, right? And somebody asked me, we don't use Twitter. I don't tweet. I'm not a bird. I don't do that. I only have time for this. You can have the exchange of knowledge and ideas with people through this, which is phenomenal. It really, really is. The world is going to continue changing. I told you we're short-term bearish on metals, long-term bullish. Everything is happening for a reason. There's plans behind plans. If you want to understand all of this, come and join the Crypto Public Desk monthly, ladies and gentlemen. One tip from the pit can pay for your entire year subscription. If you really want to learn how to trade and invest and learn how to take advantage of emerging themes in the market instead of watching how one person did A or B or got lucky on this or lucky on that, chances are they didn't get lucky, ladies and gentlemen. They were rewarded for their hard work, their determination, their diligence. I love you all. I'll see you on the front lines, ladies and gentlemen. Have a blessed evening.